Hello, everybody. December 31st is approaching really fast, so I thought I would share some of my tax tips with you guys that we have learned in the CPA program. So let's get to it. Number one, childcare expenses. You know what? If you and your spouse are both working, you have good jobs, and you have to get your kids dropped off to a daycare, day homes, nursery, you can use these tax credits. You can use up to $8,000 for any child under the age of 7, and $5,000 for the child between 7 and 16 years of age. All you need is either a receipt, an invoice, a social insurance number, and the name of the person. Well, I'm an East Indian. Our parents take care of our kids. So what we do in our household is my mom takes care of my kids. We drop off our kids to my mom's house. We give her a little bit of money for the year, and then we claim that on our tax as an expense on our tax return, and my mom claims that as an income on her tax return. That's what we do. But if you have kids, if those who go to these institutional daycares, you will get an invoice. You please use those on your tax returns. Number two, spousal RSPs. This is very important. The spousal RSPs, if you're contributing towards your spousal RSPs after you have maximized your own RSPs, even if you haven't maximized, I feel personally that even if you haven't maximized, it's good to contribute into your spousal RSP if she doesn't have any RSP. Even if she has RSPs and you're the one making more money, if you're in a higher tax bracket, you could contribute money towards her into her spousal RSP or your husband's RSPs and get the benefit of tax deduction in the year you're contributing. The second benefit comes when you're withdrawing funds. When you and your wife are ready to retire and you start withdrawing funds out of your RSPs, both of you can withdraw funds from your own RSP accounts, and both can enjoy the lower tax bracket. This way you can split income, but you have to start doing it right now by contributing into your spousal RSPs. Number three, charitable donations. This is very important. It's one of the most overlooked, expenses that we don't claim. As I said, I'm East Indian. What we normally do is we go to our churches, we go to our temples, and we give cash. It's great. I feel like most of these charitable institutions, these organizations are very, very honest, and they claim their taxes properly. But you know what? Even these undisclosed donations, they still have to claim it on their tax returns. But I'm not getting any benefit, even though I'm the one who initially gave that money. So I think it's very important for you to start getting a donation receipt from a registered charitable donation and start claiming that on your tax returns. As I've put out on the slide here, the first $200 receive up to 25% in tax credit, and anything over $200 receive almost up to 50% in federal and provincial tax credits. It's very important to understand it's a non-refundable tax credit. So it can bring, if you have contributed or if you have given enough charitable donations, it can bring your taxes down to zero, but it cannot issue a tax refund. I've given examples. If somebody has donated $700 in donations in 1 year, they can receive up to $300 in tax credits. So they can lower their tax bill by $300. Number four, TD1 forms. We all get these TD1 forms from employers. We should be getting them every year. I send out TD1 forms to our employees every year. It's important to fill those TD1 forms out properly. What I see normally is people will look at the TD1 forms, they'll take the amount that's in top box and just put it at the bottom box and sign the form, and away they go. But there are sections in there that could be applicable to you, but people just don't bother looking at them. If you're a student, if you have people, the elderly people you're taking care of at home, you're taking care of disabled people, those sections can be used and they will lower your tax burden during the year. So you can claim it on the TD1 forms, get the money sooner in your pocket, and invest and make more money on it, like get 6% on it. Or you could wait and file your taxes. Hopefully your accountants will catch it, and they will they will claim those credits for you, and you will get the money back at the end of the year. But for me, I would rather have my money sooner. So fill out those 21 forms properly. If something's applicable to you, please fill it out and get your money sooner. Number 5, maximize RSP and TFSA. I have made a video yesterday about the TFSA account. I think TFSA is one of the most powerful tools that's available to us Canadians. I would recommend you to maximize your TFSA first and then maximize your RSP, especially given the market that we're in right now. Market is down quite a bit. If you put your money into investments, into stock markets, into ETFs, you will see a bigger return in 10, 15, 20 years. Please understand, TFSA is not for short-term investment goals. It is designed for long-term investment goals. And if you have 10, 20, 30 years, you'll see bigger returns. These are my tax tips for you. If you like my video, please subscribe to my channel. Please like my videos. Give me comments how I can improve myself. Thank you.